Happy Friday and happy Thanksgiving. Hope everyone had a wonderful holiday. Mortgage rates opened this morning cooler than they were last week. 6.22% on a well-priced 30-year fix. Solid improvement from last week, 6.36. And here this week, something we have not seen in some time where, yes, it was a shortened trading week. The market saw steady improvement and effectively no volatility, which is why we're seeing the improvement in rates like we are. So let's get to it. What's driving the needle and something we need to be communicating to both our buyers and sellers as we close out this year and enter December next week. Yes, hard to believe. So first round of government reporting post the shutdown came in the form of initial jobless claims. And we're seeing a kind of an uneven response to the labor market where private payrolls are showing steady deterioration, yet on the government side, initial jobless claims, we saw a decrease there. Now, the bond market and traders are really kind of heavily focused on private payrolls, which is, again, why, as I said earlier, effectively no volatility this week because it's, word on the street is, hey, companies are laying people off, which fundamentally is a driver down in yields as we expect the Fed to step in and intervene, as we'll see hopefully next month. We saw durable goods come out this month as well, or this week, I should say, which came in higher than expected. But simultaneously, we received retail sales and more consumer inflation, which showed lower than expected. So, again, a very disproportionate read on really where the economy is and where it's heading. Pending home sales, though, on the other hand, we saw a rise. And we saw home price appreciation continue to improve healthily. And mind you, this is on the back of still higher than normal mortgage interest rates. So, again, why this is important to take note of. Through this entire cycle, we have seen home price appreciation remain incredibly steady. And if you're like me, you believe lower rates are in front of us, getting in front of that chaos as new buyers, or old buyers, I should even say, jump back into the market in January, taking advantage of it now is mission critical for our clients to set the stage for success. So December is a lot of things on the chopping block coming forward. December 6th, we're going to receive unemployment. And here, that is something we're absolutely watching closely, is that will be the last employment report from the government side before the Fed meets later that month. Additionally, we are going to see inflation data and wholesale inflation come out, and producer price index, which is something that the Fed is absolutely going to monitor and watch as we close into that final rate decision for 2025. Now, as I mentioned earlier, this is that calming before kind of the chaos kicks off next year. Buyers that are taking advantage of the market now are set up for success. Yes, rates are lower than where they were last month and where they were this time last year. So buyers that take advantage of kind of the increase in inventory that we've seen, yet reduce competition as people's focus is on holidays, are the ones that are setting up for success, because we do know what happens next. As we enter the first part of the year, as interest rates continue to cool, we're going to see continued chaos into next year. So with that said, if you're running into challenges presenting this message to your clients, please reach out. We'd love the opportunity to support. And if you find any value in this, please continue to support. Forward to as many people as you can. Like, subscribe. We appreciate you. Again, happy Thanksgiving. Hope you enjoy this holiday weekend, and we'll get back at you next week.